Thank you for joining us at XM.com. You're watching today's Daily Market Comment by Heralan Bospisuros. I'm Christina Marujos. The U.S. dollar traded lower against most of its major counterparts on Tuesday, giving back a small portion of the gains it recorded in the aftermath of Friday's astounding employment report. The greenback remains on the back foot today as well. The person responsible for the dollar's retreat was once again Fed Chair Jerome Powell, who, at a speech before the Economic Club of Washington, reiterated the view that interest rates might need to move higher and that no cuts are on the Fed's agenda for this year. After the unexpected surge in Friday's non-farm payrolls, investors revised higher their implied rate path, and although they maintained bets of a nearly 5.15% terminal rate, following Powell's remarks, they added some extra basis points to their cut estimates. They now see interest rates ending the year 35 basis points below the estimated terminal rate. Investors were likely expecting that, with the unemployment numbers now in hand, Powell could sound more hawkish than he did at the press conference of the latest FOMC gathering. The fact that he didn't came as a disappointment and allowed for some dollar selling. More Fed speakers are stepping onto the rostrum today, and should more members support the case for higher interest rates, the dollar may resume its latest recovery. However, with the CPIs on next week's agenda, talking about a long-lasting recovery is very premature, as another negative surprise could trigger the resumption of the dollar's downtrend. In the Eurozone, consumer expectations for inflation edged up again in December, according to a European Central Bank survey released yesterday, adding credence to the narrative that the ECB may need to continue raising interest rates aggressively to bring inflation to heel. According to money markets, the European Central Bank is expected to raise interest rates by another 100 basis points before it presses the stop button. This enhances the view that it is too early to talk about a potential bullish reversal in the US dollar. Euro-dollar is the largest component of the dollar index, and thus a stronger euro may consequently limit any further strength in the dollar. Combined with a potential slowdown in next week's US CPI data, this may result in a rebound in euro-dollar and perhaps allow traders to put back the 111.75 zone on their radars. All three of Wall Street's main indices rallied on Powell's disinflation remarks, with a more rate-sensitive Nasdaq gaining almost 2%. The fact that the selling following the robust jobs data was not as strong as the dollar buying suggests that equity investors are not willing to significantly reduce their risk exposure yet. This was today's Daily Market Comment. Thank you for watching at XM.com.